Today we're talking about what ultra high net worth families do differently with their money. If you want to build real wealth without feeling stressed in every market drop, I'm going to show you the 5 patterns that I see in wealthy families to show you how to stay calm and keep compounding your capital. Most people think if you're already financially successful that you must be making great decisions with your capital, but that is definitely not the case. Sometimes in the largest portfolios we see the most obvious mistakes being made, and part of that's because you're playing defense. You're worried that you're going to lose the capital, but the good news is thriving families use a few simple rules that create calm and enable lifestyle control and keep the money invested in compounding. So in this video, I'm going to break down the 5 things that these families do differently, and so you can implement them in your own portfolio. By the way, I'm Brad Johnson, and I advise high net worth families and entrepreneurs on their investment portfolios. All right, let's dive in. Okay, number 1, they separate growth capital from income capital. They don't expect the same dollars to do the same thing. They have different goals. And here's why that matters. In drawdowns, when the market's down 30+%, they're not panicking. They're not fire selling stocks because they have a different bucket of capital that's providing income to fund their lifestyle. And so they never feel forced to sell. So here's how to do that. Number 1, define exactly what your lifestyle needs are. Number 2, make some income investments for predictability to fund that lifestyle. And number 3, make some growth investments, lock in that capital, and let it compound. Almost pretend like it's not even there. Those are like private equity investments, whether they're in the stock market or in growth investment, that's long-term capital. Think of it this way. Income capital is meant to be defensive, while growth capital is meant to be offensive. It's meant to go do its thing, go out there and hunt. And so it's allowed to be volatile, while the income is meant for spending. So the key, separate the money you live on versus the money that grows. And so make sure you don't do the opposite of that, which is mixing those 2 buckets, because when the market drops, you're much more likely to panic. Point 2, wealthy families that do this well, they optimize for after-tax returns, not gross returns, not headline numbers. Money that you could actually take home and spend and not give a big portion of it to the IRS. And here's why that matters. Taxes have a way of quietly eroding returns, whereas thriving families are able to design their portfolios to mitigate some of that tax drag. And so here's how to do that. Number 1, you want to be proactively looking at your tax liabilities. Right? We got to know the numbers. We got to know what your exposure is. Number 2, we're going to use things like depreciation and tax deferral to push out that tax liability into the future. And number 3, we're going to overlay things like long-short direct indexing to start accumulating losses to offset some of that tax liability. Because if you're not thinking about after-tax returns, an impressive-looking return that is totally exposed to taxes oftentimes is inferior to a simple one that has some tax benefits to it. And so we have to reframe our brain here a little bit here, because everybody was taught to think about gross IRRs, when really we should be thinking about and analyzing and comparing after-tax returns. All right, point 3. Successful, thriving, wealthy families think in terms of decades, not in terms of market cycles or trades. Here's what that means. They think in terms of generations. They're not looking at headlines and reacting. They're making investments that can thrive and withstand different market cycles. Here's why that matters. If your plan only works in certain environments, that is a trade. That is not a long-term investment. It's really a bet. So here's how they do it. Number 1, they use a filter. It's usually a 10-year filter or longer. Sometimes it's a 20-year investment horizon. Is this investment durable? Can it generate income and returns over 10, 15, 20 plus years? And when you look at investments from that framework, it actually gets rid of about 80, 90% of them. Number 2, they stress test for different interest rates, recessionary periods, and different economic policies. And number 3, they set rules so they don't let their emotions take over and trade based on recent headlines or news. And so the key is we're building for decades. We're not thinking about the next quarter. Okay, point 4, thriving families focus on experiences, not stuff. They're not trying to accumulate more things and toys. And so here's the key there. They're spending things that create memories, not create maintenance, because more stuff adds complexity to your life. It's counterintuitive. You think, oh, this is going to be great. This is going to be fun for us. We're going to have all these nice new things, but it actually just creates more headaches in your life. Whereas experiences compound relationships. They make the things that actually matter in your life more valuable. So here's how to do that. Number 1, decide what experience actually matter to you. Number 2, be intentional. Plan them on purpose. Put it on a calendar. Think ahead. And number 3, think hard about this. What purchases and things in your life that are recurring expenses or large items that are taking up space, what is causing you stress actually and is not a benefit to your life? And a good signal for this is something that requires a lot of maintenance or upkeep, but you're actually not using it very much. For example, a third or even a second home sometimes adds maintenance, complexities, drama, new people and vendors in your life, whereas a month in Europe with your adult children is going to add a lot of memories and pictures and dividends for the rest of your life. So the key, buy more memories, not more things to manage. And funny enough, that same line of thinking applies to investing. The best portfolios can feel a little simple, but they just keep paying dividends and bringing you income over and over again. Which brings me to point 5. These families optimize for the boring. They optimize for predictability and repeatability. And here's what I mean. Their core portfolio is not going to get a lot of attention at dinner parties. It's not a brand new tech stock or new startup that either is going to be a zero or a home run, most of them zeros. And so it's not going to be super entertaining at those parties, but it is going to generate a ton of income. And so I'm not saying you shouldn't have those types of investments sprinkled in a portfolio, but you should start with the base. Start with developing that income that is there, that is evergreen, so you don't have to worry about your lifestyle. And then you can start layering in other investments. And so here's how to do that. The base of your portfolio should consist of income investments that are generating that stable recurring revenue, so to speak, that also let the principal continue to compound. Number 2, keep any small, speculative, unique, maybe tech investments in a separate bucket. That's almost like a play bucket. And then number 3, judge every new incremental investment whether or not this is going to cause you to lose any sleep at night. It sounds silly, but you don't want to be spending these years of your life when you've already made it, worried about some investment. And so if you think it's a binary outcome, either home run or zero, then size it accordingly. Maybe write a small check for that one and just assume that it's going to go to zero, and then you get good news if it doesn't. And quick filter on these investments, if it's fun to brag about the investment, well then it's probably not part of your core baseline capital. All right, let me tie all these together, these 5 points, so you can start implementing them today yourself. All right, to start, we're going to separate income from growth capital. We're going to start optimizing for after-tax returns. We're going to think in decades, not in terms of trades or quarterly results. You and your family are going to prioritize experiences over stuff, and most of the time you're going to choose boring investments over those really exciting, fancy angel investments that you heard about from your neighbor. All right, so if you're a business owner and you want to go deeper on this topic, there's resources for you below. Thanks for watching.